Hello, everybody, and welcome to Wall Street Hackers, one of the popular shows on the Pod TV network. And today we're going to discuss the stock market, which is very important to everybody, as the United States has a big coverage rate. About more than 50% of Americans own stocks, but they may not know what to do, or even worse, you have cash and you don't know what to do. And so the thing is, you do need to find out where you should be investing your funds. So with that, we do have a subject matter expert in this area, a person who went to UCLA to receive his degree in economics, then went to University of Miami to receive his law degree, and then NYU to receive his MBA. After that, spending 17 years in New York, working in Manhattan, we're going to bring none other than our Wall Street hacker, Peter Bennett. And Peter, I'm looking forward to this show because the thing is, as cash comes in, I got to figure out what to do with it. So give us some pearls of wisdom here. Where's the market going?
Sure, not the worst problem to have. And by the way, not just working in Manhattan, I could have been doing anything, as taking care of a kid in Manhattan. No, I worked in finance and Wall Street. So welcome to Wall Street Hackers, August 26, 2025. You can catch a new episode starting most Tuesdays at 6:15 Eastern Standard Time, depending on your distribution channel, and then sometimes all week. So the markets, as of this morning, the S&P was up a little bit in the last 5 days, but it's continuing the general trend of not much change since December 24, especially when you subtract inflation. We're basically maybe 2 days off of break even, or 3 days, certainly a bad week. It hasn't been a great market since December 24, and that goes along with the prediction of Wall Street Hackers and Goldman Sachs and UBS and Schwab that we're in a decade of relatively flat returns. I'm not saying don't invest. I'm saying you have to be really careful if you want to, beat the market, because it's a tough environment, it's a tough macro environment. So the big story this week was the Fed's possible shift towards an only slightly more dovish stance. There's a lot of adjectives there. This is starting to remind me of over 2 years. I believe it was over 2 years. I was saying, no, the Fed is not going to cut 4 times. It's not going to cut 3 times over a year, over 2 years. The market kept saying, oh, we're going to get tons of rate cuts. And I kept saying the market is, quote, delusional. Well, I'm afraid the delusion is returning again. Goldman Sachs is anticipating 5 rate cuts before 2026, and UBS is saying 4. The market is pricing in this kind of action on rate cuts, and there's only one word problem: inflation. So exactly what did the market get excited about for a single, probably quarter rate point in September, which we did say would probably occur? Number one, why were they excited? So Chairman Powell only hinted at the possible rate cut, and the Dow Industrial went up 800 points on his hint, or slightly dovish more stance. But the chairman did say that any changes would still be data dependent, and we have data to come in, and he left it out. Also, he discussed the Fed's goal and framework, which was adopted during the pandemic, which allowed the Fed to let inflation rise if unemployment was trending higher. See, that's the barrel I would say the Fed is over, because inflation may not be going down, but unemployment may be going up a bit, and we're still historically low. But if they have this dual mandate, and it's not necessarily all in their control in the end, but the bottom line is, if there's an inflation scare, and even if unemployment is being helped, that could really hurt the market. So the actual data was not good in August at all. I really was surprised by that, and so was the market. the data came in much hotter than expected. So we'll see what the data is and whether the market is excited or not. But we are far from being guaranteed for 4 or 5 rate cuts within a year and a quarter, a little more than that. So this, by the way, will be the exact discussion of question and discussion we're going to have in our panel discussion, which is who is right about rates? Is it President Trump or is it Chairman Powell? So quote of the week. And this is also an important point, which I didn't even bring up. This comes from Mott Capital Management and its selected quotes. Quote, Fed rate cuts don't mean lower bond yield rates. Seems like the market just figures, oh, if the Fed cuts, long-term rates and medium-term rates are going to go down. So here's some quotes. Powell's Jackson Hole speech was largely neutral with a softer tone on labor, but no real surprises. Inflation expectations remain elevated with technical indicators suggesting a breakout to the upside, pressuring bond yields higher. Historical and global examples show bank rate cuts don't guarantee lower long-term yields. Market forces dominate the curve. Ultimately, the bond rate, not the Fed, will dictate long-term rates, especially if inflation risks persist. So what I'm saying, the Fed doesn't control the ultimate rate environment. It has some impact on it, but it's also fiscal policy, and we'll be getting into that more again in our discussion. But the market just looks for any story that works. So, oh, the Fed is going to cut all this, it's a bit delusional again. Most interesting story of the week. So President Trump just signed an executive order that pushes for an end to cashless bail policies. Unbelievably, cashless bail policies, for those who don't know, allow defendants to be released from jail based on their promise to appear in court. I would point out that these are criminals that you're trusting to show up in court. Maybe the promises could be backed up a little bit better. The executive order directs U.S. Attorney General Pam Bondi to submit a list of local and state jurisdictions with cashless bail policies and identify federal rules that could be suspended or federal funds that could be suspended or terminated. So, the Fed has to push these states in because they make the rules, but it also ends cashless bail in Washington, D.C. And speaking of Washington, D.C., where so many people say, oh, this was unnecessary, even though it was a huge crime, more than Mexico City and Bogota. And all the people in Washington knew this, and they just, Democrats or liberals who hate Trump didn't want to admit it. But there have been now 12 straight days with no murders, a huge drop in crime. And as of 3 days ago, and remember, this only started maybe 2 weeks ago, there were 719 arrests now of murderers, drug dealers, and pedophiles, and 91 illegal guns seized. So this is somehow bad. There was also evidence that came out, if you, depending on your news, you may have seen this or they would never tell you, but that Washington's crime data was very slanted. There were examples like a murder case that was treated as an accident. They didn't want the crime data, but people in Washington knew. They knew they couldn't go into the parks. People would walk through Union Station, even reporters, and they're noticing the difference. And people could see it with their own eyes. So I don't see why anybody would argue this except for basically pure politics. But the citizens of Washington are going to see this, and some in Chicago are talking about the need for this, and President Trump is talking about possibly doing it, but he's also saying he won't do it unless the governor of Illinois asks for it. And the governor of Illinois says this isn't needed. So I guess maybe next week we'll talk about this, but exactly what is the racist policy? People say, well, this is racist when you send people, forces into minority neighborhoods or cities to protect the people. But what about the people who are saying it's racist or unnecessary, who don't seem to care about the people who are in the cities? Doesn't make sense to me. So next segment, why President Trump or the White House should give me a call segment, and they really should. I would work for $1. This isn't exactly in the White House's bailiwick, but it's a pretty good example of problem-solving skills. So recently, I was listening to Mark Simone, and he took a caller on the radio, and the caller said Congress should have term limits, and a lot of people think that. So Mark Simone agreed, and he said he just didn't know how anybody could get Congress to do it. Well, here's the answer. Have Congress schedule term limits for a date in the future. For instance, you could say there are limits of 2 to 3 terms, perhaps starting in 15 or 20 years. I think Congress would agree to term limits in 20 years or 25 years, whatever, 15 years, could all be negotiated out. But they would never vote for term limits now because it would be affecting them personally. And and I could understand why they may feel they have a mission. But in the future, if term limits should be applied, that would be the answer. Investment of the week. First, disclaimers. As always, Wall Street Hackers is for entertainment only. There are no guarantees on any of our suggestions, except for maybe our municipal bonds, but those have to be held to maturity, and other bonds. These are only our opinions. Consult your financial advisor. A little footnote, giving myself credit. Last week, we highlighted the higher yields that you could get in very safe states with general obligation muni bonds, especially if an investor was willing to go long, and that's what I think isn't bad as part of a portfolio, for ballast. Well, this week's headlines on the Barron's cover of Weekend Barron's, quote, the new allure of muni bonds, page 20, right at the top. And the article said, intermediate or long-term bonds probably are one of the most attractive asset classes relative to your historic value, ... So I guess Barron's, watch my show. Kidding. Anyway, this week, I'm going again against my usual strategies, but I'm going back to my Amazon strategy. But I promise a dividend pick next week because mostly I believe in dividends because the history shows over studies about 200 years how they outperform by double and triple in the long run, especially. And I think that's the way to go. But I'm returning to my Amazon strategy, first of all, because I altered it and I have to disclose it. I wanted to disclose it. So originally I was thinking I'd use options to go with an Amazon long strategy and go short on Apple puts. And I was trying to do my own arbitrage, which I usually don't do. But Apple started going up a little bit or a bit. And I realized something about shorts, which I could do another show about. It's really hard to short the market because the way the market works. It's read an interesting article. So I decided to drop the Apple short options. And I took like 1/6 the portfolio percent loss. So no big hit, but I decided to just go long Amazon. And that's my usual strategy. I've done really well on 1 or 2 shorts over time. But so what I'm keeping is I have 320 puts that are sold, and the 170 put is covering it. This creates an effective 5% of holdings in Amazon of my portfolio in terms of movement, but the most I could ever lose is 1%. I like Amazon, and that's my only tech and non-dividend stock. And the reasons are many. One, which is really interesting, I believe that AI and is probably way overhyped, and chips too, in the short and medium term. And I read a story, which has to be my next show, and it said that 95% of companies are finding that AI was not profitable at all and was generating zero return for them currently. Now, these companies spend billions of dollars and pump money into AI, and they're saying it's not helping. Personally, I know that I can see why, because I've seen AI used so many times, and I call it and say, just get me a person. I don't want to deal with the AI. It's a waste of time. It just frustrates clients, and they're not even counting that. So there's some issues with AI, and a lot of issues have been coming up. Another thing about Amazon is they are actually getting a lot of benefits from AI and robotics in their warehouses, because their robots can pick up they can help with inventory. They can pick up boxes. They can do a lot. So they will benefit. And Amazon has very reasonable valuations. It's 18 times price over cash flow, which is a little over 4% cash flow yield, which I don't usually go with, but they're spending huge amounts on investing and growing. So their actual cash flow could be a lot higher if they just slow down a little bit, which is always their option. They have a 16% return on capital, and it's basically almost zero debt, almost debt-free 100%. So it obviously doesn't have any huge risk to me. And what it does have is it has a market share in retail that's dominant, obviously, and still growing, and the cloud, where it's also very dominant and still grows. And some people criticize it, it's not growing as fast as some of its competitors. But when it's that big, it can't grow as fast, but it's growing at a nice pace. So I'm a big believer in Amazon. And if anybody's going to win, I believe it's Amazon in the long run. Next week, I will get back to the dividend stocks, as I promised, a very small allocation as a taste, in case you're not interested in Amazon, to Lamar Advertising, LAMR, which I happened to read today. And I'm sure Buffett isn't following me either, just like Barron's, joking. But I read today that Buffett just picked up 12 dividend stocks, and the two highest yielding ones included Chevron, which I'm not in and I'm skeptical of, but it's probably okay. But Lamar was one of the 12 out of all the stocks in the market. So I'll cover that next week. We get into the panel discussion of the week, and we bring in Nick. Hey, Nick.
Hello.
And the question is, who is right on interest rates? Is it President Trump or Fed Chairman Powell? And this is a complex issue. Background. President Trump has been pushing for Fed rate cuts for quite some time, as we know, and he says that he wants rates to be lowered by 300 basis points, meaning 3%. That's quite a substantial drop. His logic is, one, high rates are hurting consumers. Absolutely. High rates are causing high mortgage rates or contributing to them, and that hurts consumers. And also the housing market is really hurting in terms of sales and is struggling there. And three, high rates are causing the national debt to rise because there's very large interest rates payments on this gigantic debt, and that already the interest rates are payments are higher than the national debt. Higher than the national defense budget. So Federal Powell on the other side has been very reluctant to lower rates, and so all this logic is pretty logical. So it's a tricky question, Nick. So Fed Chairman Powell has been very reluctant to lower rates or even to commit to lowering rates. His points are inflation has been high, and even though it came down, it is still well above the Fed's 2% target. True. Lower rates would stimulate the stock market and the economy and could reignite inflation, a definite concern. And if inflation reignites, once inflation expectations get out of the Fed's control, it is very hard to bring them down again, as they tend to create a self-fulfilling cycle. This is proven in history. So these are all valid points. So, Nick, complex question. Who is right, President Trump or Chairman Powell?
Well, here's a very complex answer. They're both right. Okay. Now, how can they both be right? Well, Trump is right. If you lower the interest rates, which you're going to have to do because of the huge national debt, which we discussed on this show, Peter, you got to bring down the debt. And if you lower interest rate, the economy will boom. We've seen that before. And part of the reason why is your borrowing costs are down and people have more money when they don't have to borrow as much to buy homes or to buy cars or buy, frankly, anything. So Trump is right. But then Powell's right. The problem with that is that you could create inflation that we've seen, which double-digit, 20% type inflation as too much money rolls into the economy. So it's kind of a balancing act. When and where are you going to cut rates and by how much? My personal belief is this round in September, I believe, when the Federal Open Market Committee meets, they're actually going to lower rates about a quarter of a point. They're not going to do a lot, but they'll lower it and it will stimulate the market. I believe that's what's going to happen. And so I'm positioning my buys actually in REITs because some of the REITs have debt, and their debt they'll be able to refinance at a lower rate. And so I'm looking at those as very good pickups and dividend stocks. I know it's moving to the real estate.
Several points. One, I thought I could trick you because it is a tricky question, and you are right. It's a very complex question. a footnote before I get into that, but I don't know if you can guarantee that this is going to help your rates, Nick, because the problem is, again, the Fed doesn't control long-term and medium-term rates, which these REITs are paying. And there's been plenty of times the Fed has lower rates and the market react the opposite because of fear of inflation or just because they didn't believe in the Fed's forecast. So there's not a guarantee on that. You have to be really selective in your investments, as I would say. So the thing is, this is almost like a chicken and egg kind of thing, which is unanswerable because the Fed only has limited control, and this is a fiscal crisis we're in. In other words, government debt. And the situation is, as we pointed out, and I always say it because in case you haven't watched the show, and also so few other people are saying it in the financial world and the media, and it kind of is important. Everybody's scared about the $37 trillion debt that they say we owe, but we really, on a GAAP basis, general accounting principle, probably owe $125 trillion when you add the Social Security and Medicare promises, which are off the books. I mean, who else could do this? No business or taxpayer could say, oh, I have off the books liabilities, which are bigger than my on the books liabilities. I never said that before, but that's also a valid point. But so these are gigantic numbers. 125 trillion is more than the entire U.S. stock market, the entire U.S. bond market, the entire commercial real estate market in the United States, and the entire privately held property in the United States combined. But only a little bit, but it's basically more than everything. And these Social Security and Medicare funds are going to run out in 7 years, 9 years. There's going to be a fiscal cliff. We're going to be hitting a crisis. So the effect of this in the meantime is that they have to print money to stop it, to help this staggering growing debt, and money printing stimulates the economy. So now the Fed loses control because they can normally, if they raise rates, it slows the economy. But now rates are pretty high and the economy is booming. So they're losing control. And I would predict that this is going to get worse and worse because the Fed's traditional role doesn't fit in with a fiscal crisis. And they only have so much leeway and power, basically. I would always point out, too, that this is, even if the United States had no debt crisis, the rest of the world has a just as big one or worse, because countries around the world in continents I've looked at everywhere, Europe, South America, Asia, they have unfunded retirement plans to about the same as the U.S., but they promised mostly free Medicare to aging populations, and they are not putting money aside. Probably they have no money aside for the future liabilities. At least the U.S. is a little bit. So this is a growing problem, and they say demographics is destiny. But I would say my other point is that the president and Congress have done a lot in terms of taking the first steps to address this debt problem. At least in the United States, they've done a lot to do it. At least they're heading in the right direction. They seem aware of it. But this problem has been growing for 50 years, and so much more needs to be done. I personally did a report called The Pathway to Fiscal Stability, and it was about a 30-page report. I sent it to all the Congress people, a lot of people in the White House. I don't even know if they read it or if they took some of the ideas, but maybe they did. Probably not, but who knows? Nobody let me know. But about half the ideas, maybe I'd have to look at it, were taken up, but the other half weren't even addressed. So I still have this report, and they need to do everything possible before the 2030s, before next year. They need to keep cutting. They need to make government more efficient. They need to stimulate certain aspects of the economy that are especially interest rate sensitive, and they haven't done that, to adjust to this fiscal crisis. So we are getting to an interesting time, and the Chinese curses may live in interesting times. But that said, to leave on a positive note, because I always try to, there's still investment opportunities, and you still have to manage your portfolio, and there are ways to deal with this. So it used to be so easy. I could pick 50 stocks and say they're all going to do well. I could pick any tech stock almost, and it would do well. But we're in a fast changing environment, so you have to be very careful about where you're allocating your money and really thoughtful about it. So that ends this week, Wall Street Hackers. We will be on next week, starting at Tuesday at about 6:15 p.m. Eastern Standard Time. as Kim always says, get healthy, get wealthy. Good answer, Nick. I'll see you next week.
All right, we'll see you next week, Peter. Bye-bye.